Good morning. My name is Spencer Levy. I'm an Executive Managing Director at CBRE Capital Markets, and we're thrilled to be here at 2013 RECon. And our first guest of the day is Craig Macnab, the CEO of National Retail Properties, one of the largest owners of retail properties in the world, certainly in the United States. Craig is a great friend of the firm and client, and we're thrilled to have you. Craig, good morning.
Spencer, thanks very much. It's a privilege to be here. First meeting of the day at CBRE. Couldn't be better.
Great to have you, Craig. So, Craig, National Retail Properties has been on a tremendous run, one of the most successful REITs in the business. I believe it's 23 consecutive years of raised dividends. At the same time, you've maintained your discipline. We were talking prior to coming up here that notwithstanding the frothy nature of our space, you're still maintaining the ability to buy in the 7 cap range. Tell us a little bit about what types of things National Retail Properties is trying to buy today.
Well, we very much appreciate buying properties from CBRE, and we're sticking to our core competency of small box retail. So we got a group of colleagues that have a very good familiarity and understanding with which retailers are performing well, and hopefully we got to try to anticipate tomorrow's trends. So there's all kinds of anxiety about the internet and so forth. We've for the last several years stayed away from some of those types of categories. But I will say one thing, that to us it's all about market rent. So to the surprise of many, we did purchase a Best Buy portfolio last year. Pretty decent sized portfolio, but rents were very low, $6.50 a foot. I hope Best Buy stays there, but if they don't, I think we'll be able to release them at a good spread. So.
Well, I'm glad you mentioned that, because one of the questions I was going to ask is the market rent issue. Many of the clients that we speak to on the sale-leaseback side, so before the net lease is formed, ask us, where do we put our rents? And there's been a big debate about putting it sometimes above market, because you can capture some of that upside, but there's been a recent trend of putting it below market because you'll get some cap rate compression. Do you agree with that, or is that something that is not quite as transparent as I'm suggesting?
Yeah, I think it's an interesting question, and to me it depends on the type of environment in which we're buying and selling. Today the environment's probably as good as it's ever going to get. So if it were me and I was selling my favorite child, I'd probably put the rent up a little bit to try to maximize proceeds, because I think you can get away with it. Over the long term, that's going to come back and bite you in the tail, but right now I'd take advantage of it.
Well, given how frothy or aggressive the market is today for net lease properties, and the power seems to have shifted to some degree to the occupier side, are you seeing any other changes that the occupiers are trying to push, going from triple net to double net, or any other changes in the leases that you think may be getting a little bit too aggressive?
Well, the big dogs beat up on landlords, so and there's more and more of that, and I think what you're seeing is a number of tenants going to flatter leases. So take the dollar stores, Dollar General gives you a very small bump in the 11th year. Given the quality of the building and the type of location, I'm not sure that's sufficient. But that's the power they have in this environment, and there's plenty of demand for those properties.
Sure. And we certainly know that as you buy these assets, you're trying to buy them as competitively as possible, but pricing isn't everything. What are some of the other ways that National Retail Properties tries to distinguish itself from some of the other very strong competitors in the field that are trying to buy similar assets to make it more attractive to the occupier clients?
Yeah, and like everybody, we got to have plenty of arrows in our quiver and try to do things differently and better. And you and I were talking earlier, I know you have a tough travel schedule. We try to do the same thing. We have to be very, very responsive in this market. That means a quick closing, be very flexible while maintaining your discipline. But so we are not going to be bogged down in a box. We try to be very flexible. We'll do shorter lease term. We'll do very quick closings. And we are not buying based on credit. At the end of the day, we're a small box retail player. paying a lot of attention to market rent.
Okay.
So if the location's satisfactory and rent is reasonable, we're a good buyer.
Great. Well, thanks, Craig. Now, a lot of the market is being driven by the debt capital markets, and certainly as a publicly traded REIT, you have a lot of options, and you've used many of those options, certainly floating publicly traded debt, but a lot of people are using property level debt and trying to leverage it up as much as possible. But then again, you've maintained your discipline. You still have a relatively low loan to value for your on an enterprise basis. How much of the debt capital markets changing our business, specifically in the net lease space, and what are you doing to capitalize that or to maintain your discipline?
Yeah, so we're taking a very long-term view. We think that if our balance sheet is strong, our children are going to reap the benefit of these great properties. So we are not going to lever up. And one of the reasons we choose not to is when this meeting is finished and I meet with one of your colleagues and they offer us a large portfolio at an attractive price, we want to be ready to respond really quickly. So we maintain low leverage. In terms of property level debt, we don't think that is the right path, especially when we try to be flexible with the tenants so that if they want to modify a building, expand a building, or do whatever, without having to go to the servicer, we are much more capable of responding. So for us, while not a lot of tenants take advantage of it, it's a bonus for us.
Okay, very good. Now, there have been some discussion recently of changes in tax laws, and the changes in tax laws specifically around our industry about how internet retailers are going to be taxed similarly to bricks and mortar retailers. What kind of an impact do you think that type of change might have on some of our occupier clients? Is it a positive change, or I will ask it differently, is it a situation where we have to be careful what we wish for? And I'll talk more about that in a second.
Yeah, so I think if we're not paying attention to the internet, we're in denial. You know, in this country, internet sales are maybe 10% of retail. In the United Kingdom, they're 20%. In Canada, they're less than 10%. But the trend is clear. They're getting bigger. So small box retail, particularly service industries, we don't see much impact from the internet. But I'll say to you, you know, one thing that's kind of interesting, and you and I were talking about it earlier, how about the grocery space? And I think if you take a look at the big trends, while there's a lot of appeal and interest in grocery, right now the hottest grocers are not the Krogers, Safeways, etc. It's Sprouts, Fresh Market, Trader Joe's, natural grocers, etc. So, you know, retail is an evolving space, and there are lots of companies in these hallways, and I hate to use the term Sears, but I just walked past their booth. It's a pretty fancy booth. I wish their stores were quite as fancy as their booth.
Well, on the grocery space, you mentioned a lot of the very good organic and smaller grocers. But one of the things that may happen with the change in tax laws is that internet retailers are no longer afraid to put distribution centers in local markets, and they're going to start same-day distribution of goods, which may be an even bigger threat than perhaps some of the other grocers you've mentioned. I think you mentioned the UK, there's a 20% encroachment in the internet, but in the US, in the grocery space, the encroachment is less than 2%.
Yeah, so you know, retail is a very, very evolving category, and there's always going to be change. I think the allure of grocery-anchored centers and the pricing of them is a little overrated. And I think there will be some impact. But at the end of the day, retailers have got to provide an experience for their consumers. And if they continue to add value and provide entertainment options and keep the stores as exciting as some of them are making them, retail is going to just be fine. However, in the next 10 years, there are going to be a bunch of different players that are not the big dogs today. So,
well, I think your comment earlier regarding your investments in Best Buy speak to that, in that you're not buying based upon the tenant per se. You're buying upon the real estate. You're buying upon the rents that are in place. So there's a lot of factors. So is it fair to say that retail fundamentals overall, they're important are they improving overall, or you don't look at it overall? You have to be very micro-focused when you're looking at the different segments of tenants, different industries.
Well, we clearly underwrite property by property,
Yep.
and I think that especially in the net lease space where they're very long duration leases, while we can probably anticipate what's going to happen in 5 years' time, in 10 years' time, we're going to get surprised. And to the extent people think I'm wrong in that statement, just take a look at Circuit City. At a point in time, it had no debt, was executing very well, and 5 years later, it was gone. So, I think right now you've got plenty of investors here, be it at CBRE today, and they're all looking at a variety of things. And I hope all these credit purchases work out for them. Certainly you can borrow money against it, but if the rents are very high, watch out.
Got it. Well, one final question, Greg. I think you may have just answered it in part. What's the future? What does the next 10 years hold? What should we be doing as real estate investors to best position ourselves for the changes that you're suggesting are going to be occurring in the retail industry generally, but in the net lease space specifically?
Yeah, look, a variety of people have different strategies. What we've tried to do is make sure we understand who we are, what our core competencies are, and that we have the best people executing that strategy. And if we all continue to do that, you, CBRE, adding great people, maintaining them. You and I just visited with a colleague who's been with your firm for 30-odd years. There's a reason why he does so well in this platform. It's because of what he does. So great people make the difference.
Great. Well, on behalf of CBRE, I want to thank you, Craig, for coming back and doing this again. Great
Spencer,
job.
it's a privilege.
And
thank you very much.
Thank you very much.